this because I love to catch up with you. You look at parts of the market that not all of us do on a daily basis. So I want to get your take on what's happening underneath the cover. So on the surface, stocks ended the week with a rally, helped in part by gains in Amazon and Intel after both of those companies reported stronger than expected earnings. But we saw bond yields also tick up again, despite the fact we saw a much weaker than forecast U.S. payroll number. And so it seems like investors kind of brushing this one off, thinking maybe it's too noisy because of the hurricane and Boeing. What did you make of the report, Jeff?
Well, the payroll report, I think, is just simply, I mean, look, it shows that the September number was the outlier, not the October one. I mean, there's lots of noise in the payroll reports, as everybody points out, but it's not the noise that everybody sees. We get these months every once in a while. Everybody goes crazy over like September. And the one before that was May, if you remember that one. That one came out originally at almost 300,000. And everybody said, okay, the economy's unstoppable. And then over the next several months, it was, oh my God, we're into a recession. So the noise in the payroll reports is really the upside numbers, not the downside. So while there's some uncertainty about exactly how weak October might be, it's not really about October. The August revisions, for example, private payrolls in August, now the BLS says they're almost zero. So we had a very sharp slowdown that headed into the summer, heading into the fall before we got to October. So the market reaction to it seems a little bit counterintuitive, right? Because that would be confirmation that everything, while rates were going down July, August into September, that was on recession fears and everything else. So why are rates backing up on the other side? And I think there's a couple different reasons for it. First of all, historically speaking, you always see rates go back up after the Fed starts cutting for a variety of reasons. And some of it's just the fluctuations in the marketplace. Some of it has to do with the fact that the bond move, the rally in interest rates up until September was pretty substantial. And in treasuries, it kind of overshot on the downside relative to other fundamental markets and signals like Germany, for example. Treasury rally got a little bit ahead of itself. So that's part of it. There's a historical retracement. I do think there is a little bit of a Trump trade in that as well, where people are pricing not necessarily deficits or inflation, just this might be something different, because where we are right now in terms of the economy, the marketplace and everything it's just not working. We're heading toward a recession. Nobody wants to admit it, but that's exactly what we see in the data. So in order to avoid that case, it's not going to be the Fed. It's not going to be rate cuts. It's going to have to be something radically different to avoid the downturn. And so as the perception of Trump's success go up, as people believe that there's a higher chance that he's going to win the election, it sounds like, okay, maybe that's something different. And he can bring along a bunch of different policies that will maybe get us out of this downturn before it gets too far. So I think that's what the reaction to the payroll report was. Because if you looked at the market early on when the payroll report came out, interest rates initially went down.
Yeah.
The 10-year treasury dropped about 5, 6, 7, 8 basis points, somewhere in there. Then all of a sudden it turned around, not on any news. I think that was people in the market saying, oh, this is going to be good for Trump's reelection or Trump's reelection chances. So that's going to be more a part of the Trump trade. So I think there's a couple of short-term things going on in treasuries that isn't being reflected in other markets, including the short end of the yield curve, which is doing something very different. And that eventually the interest rates will get out of these short-run fluctuations, go back to the actual fundamentals, realize that politics really don't make any difference one way or the other. And it's just a short-term thing, and the rates will end up going back down lower over the intermediate term.
So that's so interesting because and hi everyone in the chat, and we've got some questions already, not surprisingly, and I'll get to them all in just a little bit. So it's a sort of the overextended. So it's just a natural correction as opposed to sort of proactively pricing something in, unless it's this idea that Trump, if I'm understanding you right, is somehow going to boost the economy. So we're in a recession, but if there's some kind of anticipation, perhaps, that if Trump gets in, he's going to do something that's going to strengthen the economy. But don't we already have all of this fiscal stimulus that's making its way through? That's kind of what the no landing, soft landing people who are like, hey, this economy is a lot stronger than people think, because not everyone agrees that we're anywhere near a recession. They all point to that fiscal support that was given and complain about it, in fact. So how do you view that? Do you think that's over? How does that factor into your thesis?
Well, I think, again, I'm not arguing for the Trump trade or arguing for him. I think there's
You just commented you think it's there.
I think that's part of it. And I think
Right.
that's a big part of it. And you're right. It's what would he do that's different? And I think there are a couple different things that philosophically that Trump might do different, which is rather than fiscal spending, which has been really the fiscal dominance approach of the current administration, Trump might say, okay, we're going to do tax cuts and we're going to do protectionist type of policies and tariffs and things like that. So there's just looking at it from very on the surface, very broad terms, there's a possibility you can make the case that what Trump would do in terms of fiscal policies would be different than what we have now. And then, of course, there's a completely separate discussion about whether or not that's actually any really meaningful difference and whether it'll make any impact on the economy. And even if it does make an impact, a positive one on the economy, would it be in time to turn everything around before we continue to go in the direction that we are? Right. And I know where you're coming. I mean, I think if you asked most people in the commentary class and professional investors, they would say that there's recession. There's no recession. Yeah. We're headed straight for a soft landing. That's what Jay Powell says. That's what every economist says. And then you ask about, you ask 100 people on the street, about 92 of them would say, yeah, we think we're heading for a recession. Consumer confidence is down for that reason. It's not really about consumer spending with consumer confidence. It's about perceptions of the labor market. And so we continue to get confirmation in all sorts of angles that the labor market is indeed, especially during the summertime, really stumbled pretty badly. And it's not just the establishment survey. The establishment survey is just the last one to come in.
Yeah, that's so interesting you say that. By the way, there's a hilarious, I don't know if you saw this, but there was a hilarious comment on your YouTube channel in the comments section under one of your videos. And it was from someone who said, I knew I was in trouble when I saw the size of the Kit Kat in my bag. Honestly, sizing of shrinkflation in real time on Halloween, I guess. I thought that was so funny. But so not only, let's just go back to one point. Not only do a lot of people think that we are not headed to recession, they actually think the Fed made a terrible decision and that they're just stoking inflationary risks because this economy isn't just growing. It's going gangbusters.
It's booming. It's awesome. It's terrific.
Yeah. And you say that that is just not right. They're not looking at the right things. Are they paying too much attention to sort of asset markets and the financial economy?
Well, that's part of it too. I mean, look, I think as far as this idea of Fed regret, that kind of started pretty early on in the process. And I think a lot of it was just to try to make sense of why are interest rates rising when the Fed just cut rates? Did the Fed unleash the inflationary equivalent of, massive stimulus at the worst possible time? And that came in later because, the September payroll report came a couple of weeks after the rate cut and everybody said, okay, maybe they cut when they really didn't need to. They overreacted to a couple of bad data points, and now we're stuck with an economy that isn't as bad as everybody thought it was. It isn't as bad as the Fed thought it was. And now the Fed regrets its rate cuts, and we're probably not going to get any of those anymore because inflation's on the horizon. And it sounds plausible. It sounds understandable. That's certainly not the viewpoint of, especially the short end of the yield curve in the short-term marketplace. I'm not talking about the 2-year treasury. I'm talking about really at the front end, when if we separate the part about just the Federal Reserve, you look at something like term SOFR, for example. Term SOFR has been completely locked into further rate cuts ever since. So term SOFR rates plunged in anticipation of the 50 in September. And then when Jay Powell had his press conference in the middle of September and said, you know what, the economy's really on solid footing. We're not really panicking here. Everything's kind of fine. That was what lit the fuse to this Fed regret narrative. Term SOFR didn't budge. It continued to price the next rate cut, which is coming in November. And it has, especially the 1-month maturity, has continued to move lower. Now, the 3-month maturity for term SOFR, that kind of backed up a little bit with the September payroll report in October, but then it's been moving back down too. So you put those two together, the very front end of the marketplace has said 50, 25, 25, and it didn't matter what macroeconomic data came along the way. The market has been consistent 50, 25, 25. Now, there's certainly an argument about whether we care about the Fed's interpretation of the economy or not, but as far as the Fed goes, the market says there is no Fed regret. And I think, again, most recent data we got from not just the payroll report, but JOLTS on labor data there. And really the big one for me is nominal incomes from the BEA, which were really solidly recessionary.
So in layman's term, for people who are not familiar, SOFR, why is that important? Why do you watch that?
Well, SOFR is the rate that's closely tied to the Federal Reserve's policy rate, because it's a short-term money rate, even though it's term SOFR. It's very much a reflection of what the market believes the Fed is going to do from the current perspective. We're not talking about term SOFR futures, we're talking about term SOFR. So if the market believed the Fed was suddenly regretting its rate cuts, then 1 month term SOFR would level off of where it had been after September and continue to go in a straight line and say, okay, the Fed isn't going to cut again. But with term SOFR go, especially the 1 month maturity, continue to go down after September, the market has been consistent and confident, no matter what has happened along the last 6 weeks, almost 6 weeks since then, that the Fed is going to cut at its next meeting, and it's going to. And 3 month term SOFR says it's going to cut again in December, and then you get into term SOFR futures about beyond that. But as far as the short run is concerned, it doesn't look like the market is taking the data in the same way that a lot of people are, that the Fed regrets its rate cuts, number one, and number two, that it's going to alter its at least very near-term path of cutting rates. And the reason why it wouldn't, the Fed would not change its stance or where it's going is because the economic situation is, at the very least, more questionable than a lot of people are giving it really paying attention to and appreciating. And that point was emphasized with, as you mentioned, the fact that the payroll report, despite the hurricanes, despite the Boeing strike, was much weaker than even most people were anticipating at the low side. Because as I keep pointing out, it's not just about October. You go back several months, the economy really did stumble. The reason why interest rates fell so sharply when there was such a big rally in the summertime is because we're getting all the confirmation of data looking back at it that said, yeah, there was a big change here, a big inflection, especially in the US labor market, which has implications all across the global economy.
So people would say that, okay, that short term, the overnight lending rate is showing that the Fed's not backing off, but that's where the policy mistake is. Yeah, the Fed's not backing off, but they're stupid to say that, to do that. They should be. And that's why the longer part of the bond market is getting concerned. The idea of bond vigilantes, that we're starting to see them reemerge. You don't necessarily buy that?
Well, why would we get bond vigilantes emerging now and not say a year ago, right? Because in the wider context, interest rates have moved substantially lower since last year, and the deficit situation hasn't really changed all that much. It's improved from that ridiculous amount of borrowing that took place in the third quarter of 2023, for sure. You could say that the deficit has improved, but it's just, basically a rounding error at this point. We're talking about a couple $100 billion here, a couple $100 billion there. So as far as the deficit situation goes, nothing has changed really. And the trajectory for deficits, that continues to be at nightmare proportions. Yet over the last year plus, since last October, interest rates, once it became clear the Fed was going to get out of the way of the front end, interest rates have continued to move down. And so look at what's happening in the Treasury market right now as more of a short run fluctuation rather than some kind of meaningful change in fundamental perceptions of whether it be the macroeconomic situation, the monetary situation, or the fiscal situation from the government. And I understand where that's coming from, because it looks like we have two different positions. The front end of the curve says the Fed's going to continue to cut rates, and the back end seems to disagree with why that would be. But I think it's just a short-term fluctuation, especially when you look around outside of the Treasury curve.
So the labor market is interesting. This is such a fascinating conversation. All of you who are listening, that we love to hear all sides. And so it's fascinating to hear you talk about this, because I just talked to Ed Yardeni. We're going to release that on Sunday, I think, who's always bullish, and he explains why. But he's looking at the labor market and saying, we're not seeing weakness. What you're seeing is productivity, right? The impact of technology. So, yes, maybe you'll need new workers, but this productivity gains, it's like magic fairy dust. And there are all sorts of benefits to that will boost the economy. And so you don't see things necessarily playing out in the traditional way. And there's all this strength because you've got all this fiscal support. And so, yes, there are risks, but the bottom line is that things are booming. You have a completely different worldview of what's going on, and you're much more concerned about the labor market weakness, it sounds like.
Yeah, when you have any type of new innovation in technology and it does raise productivity, it usually does so over a long ramp up period to begin with. But at the end of the day, what that means is that, yeah, we don't need as many workers in their current positions. But as that technology gets adopted, especially in broad fashion, that leads to jobs appearing in the new area. So people don't lose their job and go on unemployment or just drop out of the labor force entirely. They shift from one industry to another industry. So you don't see the type of labor market slowdown, especially in the short run, for periods where you get a tremendous amount of innovation and productivity. What we are seeing in the short run, set aside that productivity and whether or not that's maybe a legitimate trend or not, in the short run, what we see is the opposite. We see that industries are slowing down, especially cyclical industries like manufacturing and temp jobs. I mean, temp jobs have been obliterated over the summer, including the latest report. That's a highly cyclical signal that says businesses aren't optimistic about productivity or anything else, and top line revenue growth and macroeconomic considerations. They are cutting and controlling costs, which is a classic recession signal. So you don't see workers moving from one industry to another slowly over time. You see, for example, hiring that has completely frozen up and fallen off. You see the fact that from the JOLTS report, American workers refuse to quit the jobs that they have. So if there is productivity, they would be migrating to other places. They're saying, we don't want to go anywhere. And the reason they don't want to go anywhere is because they know there's no place for them to go. So what you're seeing across the labor market are not signs of long-run productivity leading to a prosperous future. You're seeing short-run cyclical indications, and now that includes the establishment survey that suggests that the labor market has not just cooled off, it's gone way too far, and we're into that, at the very least, the danger zone of cyclical recession type of downturn. And it has all of the classic hallmarks that go along with it. But if you focus on, for example, the September payroll report, which the establishment survey does that every once in a while, it just pops higher, then it looks like, okay, the labor market is robust. And if you don't, for example, also pay attention to the revisions, because the revisions the BLS just made for the summer months completely changed the perspective. What did look like the economy had kind of hit a soft patch and then started accelerating late summer into fall, now looks like it actually was going down worse. And then September happened, was just a one-off outlier, and it continues to get weaker and weaker. So even if there is a productivity and innovation and all that positive stuff for the long run, it's not showing up in the short run. We're seeing all the opposite cyclical short-run indicators that suggest this is why the Fed is cutting rates. They can see all of the same things that we can, and they know that if it continues to go in the same direction, it's going to lead to a recessionary type of situation. And that's why they're going to continue their policies as they are so far.
So we have a question from JumpTube. Do we see 50 basis points again, or just 25?
I don't think we're going to see 50 at least this year. I think we're stuck on with 25s because there is that degree of uncertainty, and the Fed, whether they will ever admit it or not, are very sensitive to criticisms like we're seeing now, where they made a huge mistake, because they believe that psychology is a huge part of their policy toolkit. If people start believing that the Fed made an inflationary mistake, it'll actually become inflation. So I think they're going to err on the side of, we need to continue to pretend that we're doing something about macroeconomic weakness, but we also need to be sensitive about looking like we're doing too much too quickly. And of course, that will change if we get more payroll reports that look more like October than not. They'll respond to the weakness as it becomes more and more obvious. But the BLS's pattern recently has been to not make it obvious until several months later. And also, don't forget, the payroll reports are already well overstated because they're way off of the trend line to begin with. So the situation in the labor market is even weaker than it appears to be from the establishment survey, which is another fact that not only do the Fed officials know, they have come out and said publicly, yeah, we know the payroll reports are overstated to begin with. So they're going to err on the side of caution, but they're also going to be careful about, first of all, criticism, not sparking more criticism, but also they also don't want to appear to be panicky either, which is one reason why Powell in September, his press conference immediately after they announced 50 was sort of like, we didn't need to do 50, but we kind of did, because just erring on the side of overabundance of caution. They don't want to appear panicky. They don't want people to think that they're really concerned about this situation. They want to be able to say that consumer price rates have come down nicely. The economy has slowed down, which has allowed that disinflation. And all we're doing is cutting rates to make sure 100% insurance that we get to the Goldilocks soft landing. and coming across as too panicky actually is counterproductive to that effort. So
Yeah,
I don't think we see any more 50s
what do
from the
they know
Fed.
that we don't know? It's always that when they start to move aggressively, it's always the question getting asked. So it sounds like you think that whichever candidate wins the election, that it's a very good chance they're inheriting an economy that's going into recession. This is such a simplistic question, but what's weighing on the economy? What's the problem? Because the bulls will give you the reasons they think. I mentioned them before, fiscal as a explanation of why we're humming along. So why are we falling into recession? What's the problem?
Well, the problem is we have to pay for the pandemic and the aftermath. We have to pay for the supply shock because a lot of what happened in 2020 and 2021 was just artificial. And it led to an artificial boom and a price illusion where a lot of businesses had convinced themselves that, this was to use the term Irving Fisher used in 1929, this was a permanent plateau of prosperity. That combined with the difficulties in finding and keeping workers in that early lockdown pandemic period meant that a lot of businesses hired too many. They got way too far ahead of themselves in thinking that the boom was going to last forever. But unlike traditional business cycles, this was a supply shock cycle. But unlike traditional business cycles, the turnaround time has been much longer because there's so much artificiality, so many distortions that happen, so much artificial support in the fiscal side. That's part of it too, especially transfer payments. So we've had this very slow shift from supply shock, artificial price illusion, hired way too many workers, to over the last couple of years, businesses realizing, oh, that economy that we thought was going to be for 24 and 25, that's not showing up at all. So we have to make adjustments. We have to control our costs because we're not seeing that economy that we were expecting. We're not seeing the recovery that was supposed to happen after 2021. It was too temporary. It was too good to be true. And so the last couple of years, this weakness heading toward recession is really just the realignment to actual legitimate fundamentals free from all of those artificial distortions. And it has been a prolonged process, as I said, but it's also a unique one because we don't have any experience, at least in our lifetimes, with this type of supply shock upside and downside. So it kind of looks like an economy that's humming along and very resilient when really it's realigning itself to where it actually needs to be given economic fundamentals of income, labor, volume, and that type of thing, free from the price illusion.
So is the next shoe to drop in services? Because that's, you talk to people who think the economy's strong and they're like, look, restaurants are full, bars are full, people are still taking vacations. Is that not the sign of strength? Is that just a sector that has yet to feel it, but it's coming?
Yeah, services are the lagging. That's really where the end game comes from. You see the manufacturing cyclical industries like construction, they get weak first, and then especially the goods economy, which, I know the last GDP report, again, seems pretty solid that that's not actually happening. But if it wasn't transitioning, then we wouldn't see this kind of labor market weakness where businesses are just now. And that's another thing to keep in mind when we talk about services in the cyclical process. We're just now getting the confirmation in nominal incomes as well as labor market data that this shifting and realigning has gotten to be not just a prolonged process, but it's getting to where it's just now becoming serious. So before it was just kind of around the edges in certain places. You could see it at very, very highly cyclical industries and parts of the economy. And they got a little bit worse and a little bit worse, but it was always just around the edges, not really enough that you could say this is really going in the wrong direction. And just this summer is when it finally started to become more serious, that we've seen all of the data confirm that the realignment has accelerated in this very same direction. And services will just be one of the last parts of the economy, even though it's the majority part. That'll be the last part of the economy that really takes the downturn as it continues to move on. So I think even it's hard to believe in some sense because this transformation and this realignment has been going on for a couple years.
Yeah.
And yet we're still in the early stages of it just because it's been so unique and so prolonged. We're just now getting the traditional, more recognizable cyclical signals when, we're 2 years into it.
Yeah, which explains, over the course of those 2 years, all of the people who were expecting a recession have been wrong. I mean, and that's what people point out. If you were looking for it and thinking it was coming, you've been wrong and you lost a lot of money. In that posture. We have a question from J&J. What does Jeff think about the long bond TLT as economic crash insurance over the next few years?
Well, I mean, if you believe the economy is heading into a recession or worse, then interest rates are going to continue to go lower. Like I said, there's so many different fundamental signals that suggest that's the case. And as I always say, look, what the markets tell us is really nothing more than that the markets are preparing a high degree of probability that interest rates go down, and worse, they're going to stay that way for a prolonged period of time. What that actually means and how we get there, that's open to interpretation. That's where that's where our discussions always come in, is we don't really know what that actually means, but the markets are preparing for interest rates to go down and stay there. That could mean recession. It could mean any number of other different ways and different paths that this realignment process plays out. But it seems as if all roads lead to that situation. So even if you're not really concerned about the economy crashing, even if you just think it's going to be maybe a rerun of the early 2000s, where we had a very mild recession in 2001, but then it was followed by 2 years of no recovery. I mean, that could potentially be what we're facing here. We get a kind of a modest recession in the next couple of months, maybe early next year, but then the economy just doesn't recover afterward. That would get you very low interest rates. So it wouldn't be the type of crash that many people are expecting, but it would still be rewarding if you're owning duration, because rates are going to go down in that scenario, and they're going to stay down for a prolonged period of time. But that, back to the original question, that's what the markets continue to say. It's not just the yield curve. You look at swaps and swap spreads, for example, they are adamant that that's where longer run interest rates are going. They're going much lower than where they are today, and they're going to stay there. So yeah, we have to fill in the blanks about how to get there, but that covers a whole lot of scenarios.
How to get there is never comfortable. Like, if we're looking at those low rates, it's rarely anything good that's going to get us there, right?
No, exactly, because higher rates are actually that's the scenario we want. We want interest rates to go higher and stay there because it's higher growth and inflation expectations. So if your view in the whole range of scenarios that cover lower growth and inflation expectations, whether it's a crash or whether it's, a small recession and no recovery, it covers a lot of negative scenarios, but that's really what we get to, is the market is saying low growth and inflation expectations over the longer run in the 2020s. And so being long duration covers you for a whole bunch of those types of scenarios. And it obviously doesn't cover you for the opposite, which would be, the bond vigilante scenario. There's too much debt, higher inflation, if that breaks out to the 1970s style, which, I mean, that's not happening, let's be honest. Or, the economy somehow recovers.
There are plenty of people who think that this is what makes it so interesting and why we love to have these conversations, because there are plenty of people who believe we are in a structurally higher inflation period. We've got some good questions coming in, and I want to try to get to them, but I do want to ask you, because you're one of the few people who look at this, who understand this. I always want to know if you're seeing any strains in the financial system. You look at all of these measures that track collateral, and this is where, as you've told us many times, and if you go on YouTube and watch Jeff's material at Eurodollar University, this is where we see it. Are you seeing any strains in the system that concern you, especially if we're looking at this recessionary forecast?
I don't know if I would classify it as a strain just yet, but there are a couple of things that have popped up since really early August that suggest there's things to keep an eye on. There's factors to watch having to do with collateral, the yen carry trade, a whole bunch of other things. I mean, just yesterday, you saw the 4-week Treasury bill drop by 11 basis points in yield, which is one of those things that, goes off like, wait, that doesn't happen. That shouldn't happen, especially for a Treasury bill. And it's probably, most likely that was tied to perceptions that the payroll report today was going to be bad, and that was going to reinforce a whole lot of perceptions. But what we've seen since early August is that repo fails, for example, have been rising again, which is a break in a 2-year trend going all the way back to October of 2022. Repo fails had been declining as the Treasury Department, outside of a couple of periods, has been issuing more and more debt, more and more Treasury bills, which make them easier to acquire. They circulate better. There's not the same type of shortage and scarcity that leads to collateral problems, which is another warning sign, because the Treasury Department is still issuing a ton of Treasury bills, and yet we're seeing rising repo fails. We're seeing signs of the yen carry trade. The opposite side of that is the Japanese 3-month government bill yield, which continues to be right around 0, even though the Bank of Japan's overnight rate is at 25 basis points. So there are a couple of things that are not, they're not huge warning signs. They're not blaring sirens, but they're just like, okay, this shouldn't be happening. And because it goes back to August, because it's tied to the Japan carry trade and Japanese financials and their positions, it actually is another indication of perceptions of U.S. recession risk, because that's what really triggered the carry trade reversal to begin with, is that Japanese, in particular Japanese, not exclusively Japanese, but the Japanese in particular, had a lot of macro sensitive investments. They were reaching for yield in collateralized loan obligations and other forms of high yield debt, which are not going to perform very well in a U.S. recession scenario. So when they were confronted in early August, really late July, throughout July, with more and more stronger signals that the U.S. recession risk was rising, that's what triggered the carry trade unwind. And there are spillover impacts in funding markets and collateral and things like that. So the fact that it's still happening here at the end of October, almost 2 months later, suggests that that part of the market, that part of the funding market, is still showing signs of fragility, not overwhelming fragility, but they're there. At the same time, it's related to everything we just talked about, that the perception of U.S. recession risk is much higher than a lot of people are giving it credit for.
China, they have been trying to stimulate. It seems like there's a lot of disappointment so far. Are they going to be able to move the needle if the U.S. is sliding into recession? Would improved China growth help offset that for the global economy, or are you skeptical about their measures?
I always use the term globally synchronized. So even if the U.S., even if China is successful at its stimulus plans, which is, that's a huge, if you're pointing out, Maggie, there isn't a whole lot of people, a lot of markets that are accepting that premise to begin with. I mean, oil is a huge one. Reuters reported a couple of days ago that the borrowing plans by the central government are likely at the top end of people's range, economists' range, at like 10 trillion yuan over the next couple of years. And oil prices didn't move at all, when everybody knows that global oil markets have a huge China problem. So you would think that if the Chinese are solving their demand problem, oil prices would pop, especially given the supply situation. Instead, the oil market's not really buying China, nor is the Chinese bond market. Chinese bond yields in the country continue to be relatively low. In fact, they're ridiculously low, and they haven't changed since all the stimulus stuff started to come out either. So markets are not betting as if China is going to solve their problem. And the Chinese aren't doing themselves any favors, because while they're throwing around large numbers and grandiose ideas, the fact that they refuse to fill in any of the details suggests that, I think the market impression is that they don't really know what to do. They know that we need to do something big, but they have no idea how to solve all of their problems, because their problems go way beyond just short-term cyclical issues. We're talking about structural issues that go back 15 years. They have all of the debt and none of the growth, which is not an enviable position. And there really aren't that many ways to get out of it that don't involve a huge amount of short-run pain that the Chinese government itself cannot tolerate. So they're kind of stuck and locked into this box. And that's why the markets are very skeptical, because it doesn't look like they really have any real concrete idea of how to solve these problems. What they're really hoping to do is, by throwing these huge numbers around, the markets will do their work for them. That somebody will be, the marketplace will be wowed by these huge numbers, and the market will start to just magically turn around. The economy will just magically shift. Consumer sentiment will be turned positive enough that consumers start spending again. So I think that's what the plan is to just try to shock the market. What is it, the old Krugman term, credibly promise to be irresponsible, and just let the marketplace sort it out for you. Yeah. Which, the actual markets, energy markets, bond markets, commodity markets, none of them are really buying this, because it's going to take a lot more than just psychological magic to fix what's wrong with China. And then you, on top of it all, you've got the U.S. question, which continues to get worse, certainly in my opinion. And I think that's the market opinion too, which just adds even more pressure, both internally in China as well as the external sector as well.
So I want to finish with this question, since we are going to hear from both bulls and bears on this channel, and try to sort it out in our mind. And I love finding the places where you disagree, because then that can help inform all of us in terms of what rings true to us, or what we think and what we need to pay attention to as we try to figure out, what the path is. And Bernardo asked, I'm going to rephrase his question, but are you ever bullish? So I don't know if you'd consider yourself a perma bear, but
No, but most people consider me one.
right,
Let's
exactly,
be
which is why we
honest.
like to clarify that, because when I asked Ed Yardeni the same thing, who interestingly coined, if you guys don't know this, he coined the term bond vigilantes back in the 1980s.
Yep.
So he's been through a few business cycles. And I asked him about his perma bull reputation. And he said that he's not always bullish. He just looks at probabilities. And when he thinks the higher probability is in the bull camp, then he leans into that. And that's sort of how he got the reputation. So I'm going to assume that you're not a perma bear, but do you feel bullish about anything? Do you see areas of the market that you do feel positive about?
No, see, the idea of perma bear and perma bull, both of them actually they're just lazy ways for people to just ignore the person talking, right? It's like,
Yeah.
okay, he's a perma bear, so I can just tune that out and confirm my own biases and what everything I'm saying. Which is exactly the charge they're making of me and Ed Yardeni and everybody else. They're saying you just have your own bias and you just continue on the way it is without changing it. I'm actually very long run optimistic. The problem is I don't know where that horizon ends. I don't know where we go from where we are now, which, by the way, being perma bearish or at least durably bearish since 2007 has been on the right side of pretty much everything. Obviously we don't get everything right. I get a ton of stuff wrong, as everybody else does. But in the long run picture, is certainly in terms of the macroeconomy and the marketplace and banking and money and everything else outside of the stock market, the last 15 years have not been good. They have been very much like you would associate with what a perma bear would talk about. But long run, people show a remarkable capability to solve even the biggest problems. The problem is we don't usually give them enough time to do so, nor is our horizon for the demand for the solution long enough to wait for it to happen. So I am very much bearish in the intermediate terms until we solve the big problems that need to be solved. And that's a whole separate discussion there. But once that happens, I believe that we are setting ourselves up for a long run future that looks like, for the rest of the world, the 1990s and the early part of the 2000s before it all went to hell. I think that what we're setting ourselves up for is a prolonged period of real prosperity, and that the challenge before us is to actually realize that we are not in an economic boom, that things are not good and are not turning around, and therefore there needs to be some degree of urgency to actually look at the problem honestly and say, we do need a lot of work to fix this. This covers all sorts of facets, including the federal government. Mm-hmm. Why does the federal government continue to borrow? Because the federal government understands the economy is not good. It is not turning around, and it is trying as best as it can. That's a loaded term, to do something about it. It's a response to that weakness. So it's one of the problems that need to be fixed and will be fixed at some point. The question is, what does that look like, and when does all of this finally align, and when does it all start to happen? And so, what, in my own personal view, and what I'm looking for, that the signs that I would need to see that make me think that horizon is getting closer and closer, I don't see any of them. Mm-hmm. So if that makes me a perma bear, then that's perfectly fine. I'm going to continue to believe that until I start to see concrete signals that the long run is actually moving in the right direction, and that some of these issues are, first of all, being recognized, let alone trying. We got to first put our fingers on it before we can think about even solving it. And most people don't even. It's not even on their radar, because again, a lot of people think the economy's booming and everything's fine. So why would we need to undertake some substantial reform? Because everything's just moving in the right direction.
Right. So recognizing it is a big piece of the puzzle. Jeff, that was such a thoughtful answer, and it rings with so much else I've heard. So we went into this week thinking that we had all these, we have someone on this side saying something, and then someone on this side saying something totally opposite. And in the end, if you really listen to what you're all saying, it's very similar. You may be on different sides of the probability. And I just had an amazing conversation, which I'll share with you all, that it's out there floating in the tech ether someplace. Pray for us that we find it, because I had a great conversation with T. Smith, who I think said something so incredibly wise, that the systems are broken and there needs to be something else, but no one knows what it is. And that's causing so much angst and dismay. And we don't know what that looks like. So like you, and he was talking more in the political realm globally, but like you, he's very concerned short term, but longer term optimistic. But getting there, what that looks like and what that answer is very uncertain right now. We're at a real tipping point. I thought that was such an interesting, wise way to look at so much of what's going on. And you literally just echoed that, but in a macroeconomic framework. So I
Well,
think
the two
it's
things are,
really important.
they're very much related. That's why they used to call it political economy, because politics and economics were basically this two sides of the same coin. And I think that's it. The economic part explains everything we're seeing in politics. But you're right. I mean, nobody knows. I mean, it's people, I think, have an intuitive sense that something isn't right.
Yes.
And I've been saying this for years. They can tell that something just seems off, but I don't know what it is. And so everybody's off looking in different directions. The people who are, some people prefer just to say, I don't know what's wrong and I'm not going to be able to fix it. So I'm going to just live in the short run, which is an understandable and perfectly a good way of dealing with things. It's not really my problem. I can't really fix it anyway. But I think there is a perception that something isn't right, and it hasn't been right for a long time, but nobody's really identifying what it is, let alone offering solutions. So we're seeing all of these various systems break down and fragment as a natural consequence, because we've gone through these types of situations and cycles, long-term cycles, and all throughout history. Nothing is really that different. And what we just, like you said, what we don't know is, how do we get from A to B? Because we know we have to get from A to B because A is no longer viable. How do we get from A to B, and when does all of that happen? And nobody knows those answers. Nobody has any idea.
No, and it's a disconcerting feeling, but we're not going to get there without discourse. So for me, what I take on that is I have to keep my mind open, listen to everyone, and kind of lean into the smart conversations, not the short-term clickbait that's going to try to stoke me or speak to my emotions. And I think that's what a lot of us are struggling against. And there's tons of industries built for that, right? So that's the kind of challenge.
Maggie, the other side of all this is opportunity, right?
Yeah.
Because what we're really talking about is, as systems break down and new systems replace them, there's massive amounts of opportunity in that transition and that transformation. So there is very much reasons to be bullish on a lot of things. And maybe Ed's right. Maybe Ed is right that we're seeing that in this innovation and technology that's being adopted. And maybe that's the solution we've been waiting for. I don't agree with that, but I mean, who knows? It's certainly positive. So it's certainly possible. So your idea of talking to all sorts of people is exactly the right one, because we need as much information as we possibly can. Maybe somebody has identified something that I haven't seen, or somebody else hasn't seen, and that will turn out to be much more important and profound than it seems to be right now.
Right. Or some coalition where you grab a piece of it all will come together, who senses that they're all on the right track. River Braid's blowing up in the chat because he thinks things have to change too, and he's got some ideas about what that should look like, and we appreciate that. I always appreciate the smart comments. Jeff, fantastic to catch up with you. We stole a little extra of your time, but such an important conversation to have, and I think a really important way to end the week as we go into what's, let's face it, going to be a pretty fraught weekend with a lot of people screaming into our inboxes. So we're going to lean into smart conversation, and we always appreciate that we can have one with you. So thank you so much.
Well, you're welcome, Maggie. Thanks for having me on again.
Okay, great stuff. And thanks to all of you. Love you guys all turning up in the chat. Enjoy your weekend. Stay sane. We are going to bring you that Ed Yardeni on Sunday. I hope I can find D. Smith, because he was amazing. If not, he said he'll come and do it again with me. Maybe we'll do it live, so we can all be a little bit smarter. But take care, everybody. Take care of yourself physically and mentally. And we'll see you all again next week. Have fun.